I'm buying 1,000 shares of an $8 stock that could triple. This isn't some penny stock or speculative play. We're talking about a $120 billion European banking giant that's trading 10 times earnings with nearly $2 trillion in assets. That chart that you're seeing shows that it's already up about 80% a year to date, but I think we're just getting started. Here's why Banco Santander could go from $8 to $25 and why I'm putting my own money where my mouth is. Let's start with the basics. Banco Santander trades at about 8.04 per share with a market cap of about $121.7 billion. That's 15.1 billion shares outstanding, currently trading in a 52-week range between 6.85 and 9.87. Don't let the single stock price fool you though. This is not a small company. But here's where it gets really interesting, the growth numbers. Look at this revenue progression. 48.4 billion euros in 2021, jumping to 54.2 billion in 2022, then 59.9 billion in 2023, and 63.8 billion in 2024. That's 32% total growth over 4 years. This isn't a declining European bank, this is a growth machine. And the profitability story is even better. Net income went from 7.6 billion euros in 2021 to 12 billion euros in 2024. That's 58% growth in earnings. Show me another major bank growing profits this fast while trading at 10 times earnings. The quality metrics back this up. The return on equity improved from 8.8 in 2021 to 13.2 in 2024, consistently getting better. Earnings per share exploded from 75% from 44 cents to 77 cents, and these are the best-in-class profitability numbers for European banking. Yet, look at this valuation disconnect. Santander trades at about 10.4x earnings. Meanwhile, JPMorgan trades at 12.8, Bank of America is at 14.1, Wells Fargo is at 12.3, and Citigroup's at 11.9. Why should a faster-growing European bank trade at 20 to 30% discount to slower-growing U.S. peers? This makes absolutely no sense. But here's what really gets me excited, the share count destruction. Look at this progression. They went from 17.3 billion shares in 2021 to 15.1 billion shares in 2024. They've eliminated 2.2 billion shares. That's a 13% reduction in just 4 years. Now, here's a massive catalyst that could send the stock to $25 or higher. Larry Fink, the CEO of BlackRock, that's the world's largest asset manager with over $10 trillion under management, recently said Europe needs deeper, more integrated capital markets to compete globally. When the guy who manages more money than anyone else on the planet is publicly advocating for European capital market development, you need to be paying attention. Here's what happens when EU capital markets develop. IPO activity explodes, M&A volume surges, investment banking fees multiply. Santander, with its existing corporate relationships across 10 countries in Europe and Latin America, is perfectly positioned to benefit from this structural shift. And we have historical precedent for what happens when capital markets get liquidity injected. This chart shows an expansion of the U.S. money supply and market performance. Will be shown in the next. But pay attention to liquidity expansions during QE1, QE2, QE3, and COVID response around 2020. Each time, asset prices and bank valuations exploded. Europe is setting up for a similar capital markets boom. This S&P 500 chart shows the same pattern. When capital markets get deeper and more liquid, banks don't just participate, they get re-rated at higher multiples. And that's exactly what I expect for European banks like Santander.
Much more forcibly, there's too much pessimism in Europe. For somebody who's been pessimistic in Europe for like 10 years, if I had my number one observation this week in Davos, the pessimism, I've never felt, the pessimism to be larger and more profound. And I believe it's probably time to be investing back into Europe, focusing on it.
So let's talk realistic price targets. Conservative case, if Santander just trades at U.S. bank multiples, call it 13 times earnings, that gets us $12 to $13 per share. That's 50 to 85% upside just from multiple expansion. Base case, add some earnings growth from capital markets development, and we're looking at 18 to 20 Bull case, if the European capital markets thesis fully plays out with continued aggressive buybacks, I could see 25 to $30 per share. Now let's be honest about risks. European recession could hurt loan demand. Latin American political issues could impact their Brazil and Mexico operations. Regulatory changes could squeeze margins. Timeline uncertainty. This capital markets development could take longer than expected, but the downside feels protected by that 10 times PE ratio, geographic diversification, and those massive buyback providing support. So why am I personally buying 1,000 shares? 3 reasons. I'm confident. First, downside protected at 10 times PE, even if nothing goes right. I'm buying a profitable growing bank cheap. Second, multiple paths to victory. I don't need everything to go perfectly, just modest re-rating gets a decent return. Third, massive optionality if this thesis works. The European capital markets revolution could be a generational opportunity. The risk reward at these levels is simply too compelling to ignore, and it's a stock under $10, so what do I got to lose?